Okay, good afternoon, everyone. On behalf of Graduate Professional Studies here at Brandeis University, we would like to welcome you to our special event webinar, What Can Established Companies Learn from FinTech Startups, with Tim Bosco of Brown Brothers Harriman. So thanks once again, everyone, for joining us today. My name is Daniel Mungin, and I'm a student advisor at Graduate Professional Studies, and I will be your moderator today. Before we begin, I would like to go over a few tips on utilizing our communications platform. You are currently in listen-only mode. You can raise your hand or send an emoticon using the icon at the top left of your screen. The picture on the screen shows an example. I'd like to ask everyone to send a brief note through the chat box to confirm you can hear me. Excellent. Thank you, Eliza. Thank you, Carol, Phil, Isabel, Nikki, and everybody. Perfect. Thanks. Please feel free to type any questions you have during our session, and we will try to answer them as we go along, because we want this session to be as interactive as possible. And now a little bit about our presenter this afternoon. Timothy Bosco is currently Senior Vice President and Head of Innovation Strategy at Brown Brothers Harriman. Tim's organization is charged with advancing the firm's global investor services strategy through the discovery, incubation, and delivery of BBH's newest and most differentiated products and services. Tim's team also leads the firm's rapid prototyping and proof of concept initiatives, developing new business strategies and coordinating interdisciplinary teams in support of product launches. Tim earned an MBA from Carnegie Mellon University and an undergraduate degree in chemical engineering from Worcester Polytechnic Institute. And now I would like to hand it over to Tim. Thank you so much for being here this afternoon, Tim.
Great. Thank you very much for inviting me. I'm glad to be here and have an opportunity to talk to everyone about sort of an interesting topic. I think first I'd like to say I'm a little bit new to the Brandeis University program, but it certainly sounds like a very forward-looking curriculum, especially in that it incorporates a lot of excellent content streams, and hopefully this can be one of those today. Just to start, I think probably everyone on the call has at least once has seen an article in the news or on the radio about how banks and financial institutions are now starting to talk more about this idea of working with fintech startups. And I can tell you, as someone who started his career in a startup company back in the days when I was an engineer at a startup in Cambridge, Massachusetts, there's certainly a lot of things that are fantastic about working at a startup. And of course, you can imagine that there are also some fantastic things about working at an established company where some of the risk is, I guess, lower as you'd imagine. But what we wanted to talk about today is really just talking to you a little bit about what we see as, first of all, what fintechs are, how we're engaging with them, and maybe after today you'll have a good sense for what at least one of the groups out there, Brown Brothers, is currently thinking in that space. So I know that today everyone's on mute, so as questions come in, certainly do send those to Daniel. I think there's a way for him to kind of field those to me. And what I'd like to do is really, I'll talk a bit and I'll pause and make sure there's an opportunity for people to ask questions, and we'll move on from there. So first of all, this quote, Silicon Valley is coming. This actually was more or less a kickoff commentary from the CEO of JP Morgan at one of the shareholder meetings last year. And obviously it was intended to be provocative in a way because JP Morgan and Brown Brothers and State Street and all sorts of large banks here in the US and globally, we acknowledge the fact that there's more activity in Silicon Valley and in New York and the Boston startup scenes, and even in London around financial services. And so we certainly wouldn't think that, or any experts would think that all of a sudden we're going to wake up tomorrow and 35-person startup companies are going to be taking over our businesses. But what we do say is that there's a clear acknowledgement that there's a speed and a freedom of development that exists among startups that we think is helping them to really accelerate how we do business, and we want to take advantage of that when we can. And we would always be clear to mention too that financial services is very complex. There's a lot different players. There's a lot of different services that are required and that are provided by groups like us. And so sometimes we get confused when we hear about some of the success stories out there where we say, geez, look at PayPal. They took over peer-to-peer payments, and that's a great example of why fintechs are here to take over the world, which is true. I mean, I think that's a great example out there of a sort of retail level consumer process that a startup company was able to figure out how to improve. But that was very isolated and somewhat simplistic. So we need to do be a little more creative if we want to think about how overall that type of an environment can help the broader industry. So we think we talked about today. I wanted to spend just a few minutes, just in case there are any folks that are on the call today that do not work in financial services. We'll spend a minute or two just talking about what exactly we mean by that. What are the different things, different types of groups out there, and how do they interact? So we'll do that. Then we'll talk a little bit about FinTech. There's a number of ways you can define FinTech, so we'll talk about at least one or two of those. And then I'll spend some time talking to you about how established companies can choose to engage with this ecosystem. There are certainly some direct ways to do it, and then there are some indirect ways, both providing a lot of value. So before I get going, I just want to check any questions from anyone. This sound like a good plan, Daniel? All right. Great. Now, so to start, just to give you a little sense for financial services and the landscape of this, at the very least, I think everybody on the call, whether you work in financial services or not, are pretty familiar with what we would call commercial banks and insurance companies. So as individuals, I'm sure everyone here has a bank account, everyone has a credit card. Everyone, I'm sure, has had to have an insurance policy of some sort, and so to at the highest level what these types of financial services companies do. But there's a whole slew of other types that are out there, and we just list a few here. And I'm sure that if you asked others from other financial services companies, they would have either the same columns I've drawn up here, or maybe some slightly different ones. But in general, this kind of covers us. If you look past the commercial banks, insurance companies, everyone probably is very familiar with what an investment bank does, really offering a pretty broad array of global financial products, but really pointed toward advisory and financing and market making, and probably both the consumer level, but also institutional level. Next category would be asset managers, and some of the names that you're probably familiar with Vanguard's, Fidelity's, Wellington Management Companies. These are groups that will collect assets from lots of different investors, whether they're individuals, pension funds, companies, whatever it may be. They pool assets and then they deliver return through the market based on different strategies that they believe are effective. The next block from there would be where Brown Brothers Harriman sits in, and this is where my sort of perspective comes into play. Custody banks, these are the groups like Northern Trust, State Street, JP Morgan, HSBC, others, where we're providing very specialized investment support services to asset managers and investment banks. And so if you're familiar with what some of those are, things like custody is actually holding the record of ownership of an asset, or fund administration. So if you're an asset manager and you're managing a fund on behalf of your clients, there's a whole bunch of requirements of you as a regulated entity to report on those and to track the valuation of that fund on behalf of your clients. And so that's kind of what we do as a custody bank. So full disclosure, probably a lot of my perspective today might come from that angle, but it's somewhat generally applicable as well. And the last two areas we want to mention, because these groups play a very important role in the ecosystem. Non-bank financial services. So these are broker dealers. These are groups that are helping traders and portfolio managers interface with the market. So really connecting buy side and sell side features of the financial services market. And of course, it goes without saying, but everything today runs on software, and so there are hundreds, or if not thousands, of different software, data, and technology providers out there. I list just a couple here you might be familiar with, but they span a pretty wide range. So hopefully that just gives you a little bit more of a perspective if you're not familiar with that, and maybe that will add some color to our conversation a little bit later. So the next thing we wanted to talk about was what is FinTech? And so what we've done here is you can't do a presentation in 2016 without a word cloud. So I had to make sure I put that here. But as you can see, there are lots of different topics that come up around FinTech. Really, FinTech might be defined as, more of a global initiative, I like to say, sort of leveraging lots of different types of digital technologies, and a lot of times they adapt those from other industries when they pull them into financial services. But the point of that is to really either replace some costly legacy system or in some ways create a brand new product or service capability that doesn't exist. And so some of the things that you hear out there today and that you see in the word cloud, APIs and even commercials that are on television today talk about banks using APIs to connect data sources for their clients. Blockchain, I'm sure a lot of you have heard of that. Blockchain is just a new technology out there that allows banks like Brown Brothers or other custody banks to store records of transactions and records of ownership without having to have a centralized authority to do so. You have algorithms, crowdsourcing, robo-advisors. So all of these things pop up. And really what I did is I took this word cloud from a group called Finovate out of Europe. They hold a conference every year. They've been doing it for about 9 years. And typically just use this conference to showcase some of the cutting edge banking and financial services technologies that are out there. So when we think about FinTech at Brown Brothers, we usually wouldn't put a established company, one that we may already have a relationship with, for a service. So you saw my last slide, just we'll mention one of them, Markit, M-A-R-K-I-T. It's a data provider. They have also services, data services. We have contracts with them. Our clients do as well. We don't necessarily put them into the FinTech category, although some others might, because they've been around. Yes, it's financial services, it's technology, but we want really to focus on FinTech as being that emerging level of new technology where these companies are really isolating a specific capability and they're trying to become that established company over time. And one thing to note as well is that this isn't all just buzz. There are it's easy to see that there's growth if you just look at where the money is going today. So, back in 2008, I think the average or the total amount of investment into FinTech, as we call it, was under $1 billion. And then just last year, some sources claim that there was over $12 billion invested into FinTech. And so that's a pretty big jump over that number of years, and it shows that there's promise. One thing that's also interesting to note is that of that 12 billion in investment, 1 in 4 participants were actually corporations. So that investment is not just coming from venture capitalists or from private equity funds. That's actually coming from companies, even like groups in my category, in the custody category, who are looking to tap into this directly. There are certainly some drivers that led to that sort of growth, and I'll list out a few of them here. Number one is that there certainly has been a shift in the industry when people talk about saving cost. It's for a while it was about labor arbitrage, bringing your processes from maybe the U.S. or from Europe into Eastern Europe or into some Asian countries where there was some arbitrage on cost. That is very quickly going away. And so there's not as much opportunity. So really the push today is to bring automation and technology and to drive down cost. Another example would be just in general with the number of different consumer level applications that are out there that we all use and we're used to, there's a new expectation among our end clients that their digital experience needs to be modern. And so even though in a custody environment, our users are large teams of business analysts, those individuals that work in those processes would be quite disappointed and probably wouldn't give us a lot of high marks if our applications were really old looking and kludgy. And so that's been a driver. One other thing I'll mention to you too, when we talk about innovation and how fintechs are accelerating themselves here, a lot of that's to do with the fact that this is very digital in nature. Meaning if you were to compare what startups do in, let's say, the manufacturing world or the startup that I came from where it was hydrogen fuel cells, we were building hydrogen engines, there's a lot higher capital requirement to make a difference and to actually break through for those types of industries than ours. And so what that means is for folks with lots of great ideas who want to make it, they're flocking toward fintech because they don't always need to have as much money to get that going. And then one last thing, looks like we have some questions, is what I would say too is I mentioned a little bit earlier, the success of technology-only firms that are out there in definitely retail payment spaces, and you hear a lot about some of those, Square, Mint, Apple Pay. That's certainly helped to convince the market that this is possible. And so that's we kind of look at some of those examples as reasons why this is driving forward. I'm going to pause there. Looks like we have some questions. Daniel, I'm not sure how you want to go about answering some of these, or
Yeah, if I can, what I'll do is I can read the question out loud so everybody can hear it, and if you want to field it, feel free. So we have a question from Isabel who asks, who says, one of your slides mentions that fintech is shifting from people process to automation slash technology. We can see that in mobile banking. Although these are all great movements towards change and improvement, I can't help but think about what effects that will have to older generations and those who prefer in-person service. Are these programs offering any transitional assistance to such market, or is this market not big enough to cause any immediate concerns?
very good question, and I'll give you some insight into that. Although I'm not in a commercial banking type of a environment, so I don't have direct access to that type of strategic planning. But I think what you'll see is that a lot of these mobile technologies, believe it or not, are actually being utilized by some of the older generations. I mean, to be honest with you, I'm not on Facebook, but my grandparents are. So I think there is a little bit more adoption than you might think. But it's very different. I tend to only be able to speak to the sort of the custody banking side, investment asset manager side. But I think you bring up a very good point, and probably something that's worth looking into. All right. Should I move on to the next set of slides real quick?
I think so.
All right. So at the end of the day, I guess the question really becomes, why is it really worth talking about all of this? What's the end game? For starters, I think it's pretty easy for us to get sucked up into some of the hype that you read in the news. Really, when you break this down, the decision for any established company to get involved with a fintech or a startup really should, in my mind, only be about one thing. It should be about uncovering new ways that you're going to actually create new value for your clients via the products and services that you sell. So that really means generating some sort of additional revenue opportunities that didn't exist before, protecting market share that is important to you in your space, and then a lot of the time this is to do with uncovering material cost savings. So in my mind, there really isn't one right way to go about designing your approach to working with fintechs. But I think that there's recognition in the industry that there's room to improve. We often think about it as if any of us were to start from scratch in our space, and especially in banking, if we were to ask ourselves a question, if I were to start from scratch today, is this how I would do it? The way that we're going about it today, and in most cases, that answer is certainly a no. So when we look at this concept and what might draw us to fintechs, it's really to get that discovery, incubation, and delivery of new products. And so we look at there being 4 different sort of pillars of that. For us, in order to stay competitive, we believe that we need a way to jumpstart these innovation initiatives very early in their cycles. We want to be able to sniff out opportunity, but also know when to avoid traps. And so by connecting with some of these early companies, or at least observing them, you can get a better feed, a better sense for the trajectory of some of those new technologies. We also want to be able to respond quickly to disruption, and clearly you don't want to do that in a way where you're having to always take big risks or make big investments. And so there always comes that question of, when is it appropriate to be a first mover, and when is it appropriate to be a fast follower? And in a lot of cases, these new startup companies and fintechs give us an opportunity to not have to be a first mover. We're able to sit back and be a very fast follower and help to mitigate our own risk. But the point being that in our space and the number of products and services that we offer and the responsibility we have to our clients, we really can't afford all the time to bring on risky business. Some of these smaller groups, this is the only thing they're focusing on. And so, it's important to them, but the impact on their own ecosystem is a little less than it might be in our space. We talked a little bit about being opportunistic, about promising new technologies. This is the best way for us to understand what's coming and what's new. I mentioned a little earlier in the discussion, a lot of the new technologies that are coming in, we think of them as new in our space, but realistically, they're not new. There are things that have been done in other industries, and we're finding new ways to apply them to our industry. And so that's important aspect for us to be able to see ahead of time. And then lastly, if any of you had a chance to read the article that I think was attached to the invite for the webinar, talk a little bit about failing fast and forward. Certainly a buzz term, makes a lot of sense, but it's probably a little bit of a misnomer. We here at Brown Brothers, the group that I'm in and that I manage, you can almost think of us as a startup company internally where we're taking new technologies, we're taking concepts we're learning from fintechs, and we're building POCs. We're actually building prototypes that are real and dynamic, so that we can early on in the cycle get a sense for how applicable that's going to be well before we make any large investments. And to put that into perspective, a large investment might even be classified as paying more than $500,000 toward soft dollar resources in a POC. Sometimes we want to make sure we're investing in this technology and these concepts even before we get to that very, very small stage. So how does one go about choosing the right model for engagement? Because there's a few different ways that you can go about this. We talked earlier about during the intro, indirect and direct approaches. From a indirect standpoint, maybe a little more passive way to interact with this ecosystem. That tends to be about really observing the behaviors of startup companies, trying to model them into your own processes. And so we're going to talk a little bit about that last, because that is probably where, at least in our case, where Brown Brothers fits in best. But first, I'd like to spend some time talking about the different active ways to go about this. And this is where established companies will contribute directly into the ecosystem with a more symbiotic relationship with those groups. So we'll sort of outline a few different ways to go from a direct model, and just to quickly explain what you see here. So what we'll break down on this table will be, three types of what I would call direct engagements: public collaboration, private, and then acting as an investor. And we'll talk a little bit about the role, how this is you're investing, what the expected return might be, and what the commitment is, what we think their ROI potential could be, and the risks to both parties. So first, in terms of public collaboration, I don't know where everyone's background is on the call, but I'm assuming that most of you, if you're part of this program, have some connection to technology. And so at some point in time, you've had or witnessed there being these public collaboration opportunities where there's one central or maybe a small group of established companies that act as a public facilitator, and their role is to really drive education, and in some cases maybe be a central point to initiate open source development for very specific use cases. And so this is typically really just a mentorship role. You're sponsoring events, and for the most part, you're trying to associate your own brand with this initiative, with this sort of concept of being forward-thinking more than anything else. So the return on that, fintechs can often provide some connectivity for you into their environment. It also helps you to build your innovation brand a little bit, but the commitment is low, doesn't cost a lot, probably just staffing costs, soft dollar costs. But of course, that comes with the trade-off that the ROI is usually fairly low for things like this. It's hard to really value what that brand equity is that you're gaining. So I'm sure that's a component, but largely the ROI is usually low for these types of engagements. But there's certainly not a lot of risk there. What I'd say is on the startup side, the risk question is a little different because while there's a lot of publicity, these types of arrangements allow some of these startups to get recognized. We've sort of put that in a medium risk category because the unfortunate truth is that a lot of the established companies are going to be fickle about their commitment to these types of things, and so they don't jump into it and automatically want to share all of their ideas, although they're happy to hear what the startups are doing. They tend to move at a slower pace. And the other thing we'd say too is that in some of these instances, established companies that jump in and want to be part of this may have a somewhat different use case or application of the technology the startup company has, and then in a lot of the cases that draws the startup away from their original plan, which may have had legs, and they go down sort of a rabbit hole. So just something to mention. The next thing would be a private collaboration, and this is something that I'm sure everyone's heard about as well, where whether it's multiple established companies or just one, but what you want to be able to do is the same type of thing in a private setting, but you're facilitating education and new concept development. So working with groups to brainstorm via things like Shark Tank events or just traditional brainstorming sessions. It's direct mentorship. It's in this case going to be very targeted solution design, and what you're really allowing the FinTech to see is they're getting direct access into what your own client insights are. End of the day, these FinTechs are there to eventually sell product or sell themselves, and so it makes sense that they'd want to know what they should build. When I look at the commitment level, this is probably a little more than in the public collaboration space because you're designing this whole program, and what comes along with that as well when you start to work one-on-one is the larger IP concerns that you might have, and so there's a lot more papering that goes into some of those relationships. ROI a little higher. Obviously, what you could get out of it as an established company is something that is usable to you. It could be customizable to you. Maybe gives you a first mover advantage, but it likely means that you're paying for a good chunk of the development costs in that case. So ROI is not always as high as you would want. From a risk perspective, even aside from IP, one of the things we think about a lot here at Brown Brothers is that as an established regulated entity, it's very difficult for us to work with some of these smaller companies. They don't necessarily pass muster when it comes to our very stringent vendor due diligence processes or reviews. And so we always ask ourselves, as interesting and fun and exciting as it might be to work with some of these groups, would we really want to put our own clients in danger of having a process fail? That's a production process based on a sort of unproven technology, or even if the technology is proven, just an unproven setup in general, infrastructure with some of these small groups. So the startup risk on this side is probably extremely high because now they're locked into one group. And what I'd say is most startups, if you ask them, would really want to work in this type of an environment only if they had to, right? Because there hopefully is lots of ways for them to gain funding, equity, debt, whatever it may be, grants, government grants. But the minute they tie themselves to a company, the more chance they are to be bound to those to that particular company. And then finally, the investor side, and this is one thing I should mention too, is that a lot of the larger companies that you read about are doing all these things at once at the same time, but very few of them are actually really doing anything meaningful from an investor perspective. And what I mean by that is a lot, you hear about groups like Citi Ventures, where they'll carve out funding from the firm and resources to actually manage a portfolio of different innovation projects that incorporate fintechs. And so that they're really setting up their own venture fund, and so that's going to take time, resources, obviously expertise, but also you're needing to add capital into this type of fund structure. What you get out of it, clearly, if it goes well, you get equity ownership in companies that will grow, and that's always the hope in a lot of these cases. Second to that is that you sort of have control over that fintech strategy. If you're investing in them, you get to really tell them exactly what to do. Large investment, ROI, much higher potential. The risk is certainly high. I forgot who it was that mentioned this, but fail rates for fintech startups are well in excess of 90%. So you have to really have the right plan in place to be able to stomach that type of risk. And from the start perspective, much less control over your strategic direction, probably not as interesting as being able to go off and do this on your own. Let me pause there again just to make sure there's no questions from anyone in the group. All right. So the last thing we'll talk about is about the indirect strategic perspectives about working with startups. And I think for the most part, this is where the majority of us out there really find ourselves. In these types of situations, we certainly recognize that there's excitement around working in a startup environment. Things move a lot more quickly. You get to avoid a lot of the red tape that is in place in a large company to keep us safe. So a lot of attractive things about that. And so, what we tried to do as we designed the structure of our innovation team here at Brown Brothers is to figure out exactly what those advantages are that startups seem to have, and figure out if there's a parallel to what we're doing today to help us design our program. And the idea there would be ultimately to allow that to feed into what our investment strategy is going to be, how we're going to look at taking on new projects, what the filtering system is going to be, and how do we know if we're failing or succeeding. So the first thing that we do is we took a look at some of the the factors that we think we know threaten a startup success, and figure out what they do to mitigate the risk there, and then figure out if their approach is something that we can model. And so we list a few things here. Obviously, we're going to talk a little bit about technology landscape, how they build capabilities within their groups, how they make sure they're working on the right problem and not just having a solution without a problem. Obviously, speed to market is important. Things move quickly in a startup environment, and not just because everyone is excited about a new technology, but the fear of being displaced by a competitor is much, much higher in that environment. And then think through a little bit of how they manage active portfolios, and not just attaching themselves to a single idea. So starting at the top in terms of technology, what we've sort of found and understood, having worked with groups, and even before we get to this, I should maybe explain to sort of give you a sense for where we get some of the information we're talking about here. And I'm sure this is no different than most groups that are out there, but we're fairly tapped into the fintech world in a number of different ways. The first is that we have relationships because we're a financial services company, and we have our own private equity clients and investors that happen to be our clients. They provide us access into certain environments that help us to make connections. And so one of the groups out in Silicon Valley, I'm sure most of you have heard of them, Andreessen Horowitz. It's one of the biggest private equity venture firms in the world in Silicon Valley. They invest in all sorts of groups that you would know, things like Twitter and Facebook and others. So we have a relationship with them. So they bring us in periodically, and what they get out of it is that they're introducing their portfolio companies to a potential client. They're also bringing us in to be a subject matter expert to help really fine-tune the business models for some of these companies. What we get out of it is clearly the ability to go see that new technology that's out there that we may think it provides us with a competitive advantage. And more often than not, it actually just gives us ideas about how we can change our own existing models to be more efficient and more forward-looking. So that's one example. Another one would be in our industry, there's a group, international industry utility called SWIFT, and maybe some of you have heard of SWIFT. within Swift, they have their own startup accelerator called InnoTribe. And so we are a member, or I am a member of that group. And what that group's intended to do is, it is an industry nonprofit organization, but there's member fees to be part of this, and some of that money gets funneled to a venture fund. It's not very large, but what we do as an industry is we, throughout each calendar year, we get together and think about what the most important use cases might be for our industry at the time, come to consensus on that. And then we have InnoTribe go out to the market, and they find all sorts of different global fintechs that may have an answer for that use case and that challenge. And so typically they'll do 3 or 4 of those. They'll reach out to 12 to 15 startups for each of those areas, and they'll whittle it down to just a couple. And at that point, they'll create a project plan, and we'll actually do a proof of concept with a few and compare the results. And at the end of that year, we will report back to all the different fintech, all the different member companies of Swift, what the result was. And so that's very helpful. It's very specific. There's a lot of great participation, and for any individuals, it's sort of an indirect cost because it's not something that's an outlay that we have to budget for. And then finally, the other way that we do it is just being here in Boston. I'm sure you guys are aware of this, and having clients that are in New York and in San Francisco. We do our best to attend as many different local startup type events. And here in Boston, there's a very active program called TIE, which is an Indian entrepreneurship group. And Brown Brothers, very specifically, Brown Brothers sponsors a program that they run, which is called TIE Scale Up. And that's where different local groups that have collected some funding have gone out to the market, and they're looking to place their product or their concept, but their business model is not quite finalized, not quite perfected. And so they'll leverage our resources here to do things like just connect them to professors in marketing and finance at Harvard or MIT that we know, introduce them to investors that we have. So some of our private equity clients that give us money so that we can invest it on their behalf, we'll introduce them directly in person to some of these small companies. And that creates a really dynamic ecosystem here. It's enjoyable, it's fun, the companies get a lot out of it, and I think it's sort of helped our brand in a lot of ways. We do a similar thing, maybe not as formal, but in our Krakow, Poland office, where in Central Eastern Europe we have a lot of different fintechs that are popping up, and so we host those groups in our offices and make sure they have guidance here and there, so we can stay tapped in. So getting back to our table, so we look at technology landscape. Obviously, things move quickly. You'd expect that. What we know is a success factor for a startup is that they're always aware of what's coming next, and so we think that's important for us to do as well. And so what we need to do is invest in that time, have the right people, tap them into the right types of environments so that they can track that as well. And so part of that's through our innovation team here at Brown Brothers, but the other part of that is making sure that sort of innovation and technology is a key component of every product executive's annual plan. So at least one person from every product area of Brown Brothers is dedicated to this, and is required to be active in the market. So we're always keeping up with where technologies are going, what we need to stay competitive with. The next idea is building capabilities, and clearly it comes down to a lot of these cases coding, and that does make sense. What we tried to figure out on our side is that we obviously have developers here. We code, we build product. But what we didn't do until just a year ago is really have an active sandbox program where we have the skill sets and the technologies here in-house to be able to build applications that look and feel like production applications without having to write a single line of code. And the reason we think that's important, and it sort of does lead into the next row here in the table, what our goal is to get our ideas out of PowerPoint and never use PowerPoint again, and actually put these ideas in our clients' hands directly. We'd rather show up at a client meeting with an iPad, hand that to a client, allow them to move their hands around it, click on things, open up different windows, and actually experience our new concept in their own user time. So not just us speaking at them, but let them absorb the information and the concept the way that they would do that. And by identifying the right software to do that, the right skill sets, we can actually turn this stuff around, spin up new product in a matter of weeks, deliver that over to our clients via a link, and they can play with it as if it's in production. And we get a lot of feedback from that. Helpful to us in our design program, helpful to them because they're getting to see a little bit more forward-looking approach to this than they've seen in the past. Speed to market, clearly we know that startup companies tend to intentionally really reduce the complexity of their early releases, and you want to get that minimal viable product out the door so that you can get some revenue generated, get your name out there, beat your competitors to the market. We're no different. We think that's important for us here as well. So we really do push proofs of concept. Once we move on from there to our first version, we are becoming more and more disciplined about keeping scope out of that first product version, getting out to the market, getting into people's hands. Because a lot of the time, if you have too large a scope, if you have too high aspirations for your first release, and you come back to your developers and ask them, and they tell you they're done, odds are it's actually too late. So you need to move that time scale up. And then finally, we think about pivoting to new opportunities. We want there to be an active portfolio. We talked about fail fast, fail forward. That only works if you have something else to do. And so in order for us to have to cultivate this type of a portfolio concept, it does require a little bit new thinking. And this may be the case for some of you in the audience, but one hazard that you fall into in this type of space is when there's so much approval, there's so much buy-in required from senior folks, and from like Brown Brothers, it's our owners, our partners, to move forward with a project. That may be fantastic. You may get that support from the partners that you need and from the owners, but it actually sets up a hazard for you, because if you find out 2 to 3 months into the project, you've learned something new about the industry, about your competitors, about the technology, and this isn't the right path, it's so much harder to turn that project down and to say that it's a fail fast, right? Because there's so much invested in it. So what we've actually done is set some sort of arbitrary limits for how much we're going to invest, and allow us to have a portfolio within our innovation team that isn't subject to the same types of scrutiny you might see on, let's say, a production software package upgrade that has to happen at the firm. We're separate from that. The trade-off is that we reduce the dollar amounts for that investment. We make them manageable so that we can kind of add some fungibility to our portfolio as we move forward. Before I move on, I want to stop. I think I see a couple people typing questions. I can wait a second to get to those. Looks like Emma and Nikki are typing, so I'll just wait one quick second.
Okay, so M's question is, so do you see the opportunity for individuals with a FinTech degree to work in the established financial industry as opposed to having to create a startup?
That's a great question, and I would say absolutely. One of the things that I talked to the GPS team about a few months back, when we first were connected, is how practical a program this is. I think that there's especially in Boston, New York, and in San Francisco, there's a huge market for this type of skill set and this new subject matter expertise. So I would say, yeah, I think there's lots of opportunities, and what I mentioned too is that, yeah, certainly frustrations, as you can imagine, working in an established company with the long-standing legacy controls and processes that are in place. But that does come with a sometimes positive trade-off. The risk profile is much lower. So someone that's interested in being in a very exciting environment, given the opportunity to be creative, tapped into new technology, but not necessarily looking to be laid off in 7 months. I would say there's lots of different opportunities out there, especially at the banks here in Boston, to get into roles like this, and they're popping up every day.
Okay, we have another question. This one from Nikki. What do you think is the greatest challenge that companies need to overcome to move into the fintech space?
That's a good question. I mean, I think probably the willingness to take to maybe go a little bit outside of your typical business plan, business model. Um, you know, we joke around sometimes among our peers in the industry that a lot of us have a bit of an autoimmune response to change, and so within pockets of organizations like our innovation team, maybe that's not the case, but overall, there's a good reason why these companies have been around for 200 years and are successful is that they don't take outsized risks with not just investment but just even how they build their brand and their messaging, how they position themselves. So that one of the challenges is getting over that. And I'll give you an example. We talked about blockchain earlier, and that's the biggest buzz right now of all things in financial services. And there's not a whole lot of education about what it is. And so what's happening is you've got uh, a lot of fear of missing out on an opportunity. So banks are jumping to this, not really knowing what they're getting into. And also there's a connotation that's sort of negative about blockchain that's related to Bitcoin. And I think most banks would do anything they could to avoid having their name next to the word Bitcoin in an article in the Wall Street Journal or anywhere else, even if it's for a positive message. And so that's preventing banks, and in some cases, even for us here at Brown Brothers, to be overly willing to engage with groups in that space. So I would look at that as just an example of one of those types of barriers. All right, I'm going to go to our last slide and talk to you a little bit about how we take those, we'll sort of call them lessons learned, and the FinTech strategies and how we might apply them to an actual product development cycle. So first, just looking at these two axes, on the vertical axis, unitless here, but just the relative investment you might make in terms of any combination of hard, soft dollars, what have you. And then the horizontal axis being more or less time in terms of a development cycle. And who knows what the real shape of this curve is, but everybody could probably imagine that the risk of failure dramatically declines over the product life cycle as you move outward on it. And so if we kind of overlay that slide, it helps us to figure out where exactly do we want to how do we want to design our investment model? Where do we want to have where do we want to adopt startup strategies, and when do those not really make sense? So one of the things that we do here is we really break up the life cycle into a few different buckets. And nothing earth-shattering here. I'm sure most of you would draw this up yourselves from a blank slide, but you have research that you do, sandbox stuff, meaning the sort of testing, the solution testing we might do with clients. You actually have high fidelity prototypes that are dynamic, your MVPs, then obviously you get into your version ones, your next engine maintenance. And if you look at these yellow bars we have, the bottom of the bar is sort of that minimum amount you might invest, and the top being the maximum you might invest. And so there is some overlap, but you can imagine that you'd have little investment and not a huge range of investment for your plain research that you might be doing. That's got to be a little bit bigger in a sandbox environment because sometimes you're buying licenses that you might need. Other times you're bringing in consultants and experts that from outside that bring in new perspectives on the technologies. When you look at the size of our prototype box versus our MVP box, one thing to note is clearly their prototypes are smaller. There's a smaller range of investment there, but it's not dramatically smaller. So while we do say that prototyping is cheaper to do, we don't want to over exaggerate that. I think in order for prototypes to be effective, there's an investment of time. That's where you want to do it. That's where you want to be able to really rapidly fine tune your ideas. And so the combination of the time it takes to build a great prototype and perfect it, and obviously the skill sets are involved. Obviously, prototyping isn't free, but one of the things we definitely drive here at BBH is this idea of iterative articulation. And so we force upon our developers and our designers to have very short time cycles. And so we require them to build idea, build screens, and show it to us right away, and show it to clients right away. So we're not waiting 2 or 3 weeks to get a design back and then having 55 edits. We're actually doing 1 or 2 edits every single night, and we think that's been really effective. But if you in the rest of the curve, I think sort of makes sense probably to everyone, where your version ones still require a fair amount of investment after you build your MVP, and those are critical. But we want to also make sure that, to the best of our ability, as we move along the product development cycle, that maintenance box is always intended to be minimized, and so that starts all the way back to the prototyping stage. We don't want to build products that you can launch in the market, but each year require almost an equal investment to keep them up and running. So that doesn't necessarily mean that you have a chance to redesign how the product would work, but it does help you decide if you want to enter into a new product area or actually stay away from it. And then what we do is decide that if we kind of balance the peak of the curve here that we've designed, what we have with these investment profiles, and then where we might think the risk of failure starts to level off, that's where we see us really applying those startup strategies to the left versus to the right-hand side, where we might look at that as being more of an established leader and following some of the more traditional product development lifecycle components. So hopefully this was somewhat helpful to folks. I want to make sure that we have some time for questions. It looks a couple came in.
Yeah, Tim, we actually have a question from Lucy. Who wanted to know what advice do you have for someone interested in transitioning into a more fintech-focused career?
Well, I think it starts with being in a program like this one, I'd say for sure. Very focused and very practical. So I think that's good. But really, what it comes down to is building a network. And there's no better way to do that than to find yourself immersed in the environment. And so an example of doing something like that, if you're familiar with Mass Challenge, they have probably coming up at the end of the summer, they'll have a big event here in Boston. They'll have hundreds of different startups, and it's kind of neat to be involved with those things because you get to go meet people that are doing really neat stuff. You're tapped into that environment, but you're also meeting people that either would love to hire you or are going to be asking you for a job in the short future. So it really, I would say, build a network, get to meet as many people as you can. There's a lot less formality around recruiting. It's unlikely you're going to find a up-and-coming startup fintech that has a corporate training structure like Goldman Sachs might have. And so you're not going to be drawn into these as much as you're going to have to find your way into them yourself.
Okay, I think we have, it looks like we have another couple questions coming in. And wanted to know, is the need for financial institutions to constantly have new things rolling out new? And if so, how does this affect business costs?
Well, certainly in our space, it is important to have things that are rolling out and new. Um, and so that's certainly important. Where we sort of couch that is, and how it relates to building new product and interacting with fintechs, is we really refer to it as really our constantly improving our digital client experience. And so our clients are a little bit different than Bank of America's. Our clients are not necessarily individuals. Our clients are institutions, but those institutions have many staff members that use our products. And so for us to stay on top of the market, it's not just building a better app so that the 23-year-old corporate actions analyst only has to click F11 3 times instead of 200. It's also about creating new value with product that drives at new financial reward for our clients. So just a very quick example here in the couple minutes we have left. We have a product at Brown Brothers where we're able to aggregate trade activity that comes through from some of our big, large asset managers when we're talking like 30,000 trades in a day. And then rather than have that asset manager manage their own foreign exchange through an FX desk, they can actually allow us to do it in an active manner, but passive to them. And so the trades come through our system and we can pull out the FX demand and execute that on an active desk and then instantaneously report that back to those different groups. And so for them, there's value there. And so they were able to save a lot on not having to manage a desk, and they also have very good execution. And so the fact that we created value allows us to take a piece of that value, and now we've created value for ourselves. So those are just other examples of how you constantly have to have new products and ideas to stay competitive in our industry. That gone are the days where you can rely on just having great client service for an old product.
Tim, thanks so much. I just want to remind everybody that that the room is definitely open for additional questions. So if you have them, I would just ask that you type them in type your question in the chat area, and as we only have a few more minutes left. So we would welcome any questions you have.
And also feel free, if you don't have the time to type them in now before the end of the session, if you were to send those on to Daniel or others at Brandeis, I'm sure they can get forwarded on to me, and I can find some time to connect with you and answer those questions.
And if I may, while we're waiting for some of the questions to come in, I just wanted to mention or discuss with everybody that Graduate Professional Studies is excited to announce that we will begin offering a Master's in Digital Innovation for FinTech beginning this fall. The program, like our other 10 programs, is part-time and fully online. And the classes are taught by experienced industry practitioners. I'm going to pause that for a moment. Maggie had a question in terms of what skills you think are most vital for students interested in FinTech to gain.
Probably there are probably lots of different ways to answer that question. I think in today's world, the ability, even if you're not necessarily a developer and coding in Apple's Swift language or Objective-C or HTML, even if you're not a developer, it is important for you to have an understanding of what it takes, because you're either building a product at a FinTech and you're relying on developers, you're managing them, you're assessing them. So I think that is one skill I would certainly promote is the ability to code or have appreciation for what goes into that. So I would say that, but also just an aptitude for technology in general. The ability to kind of see through false trends in technology, kind of understand the real value proposition, and that's hard to do if your understanding is at such a high level. You're not able to kind of see potential challenges that might lie ahead.
Thank you so much. I just wanted to also point out that you can see here that 3 of the exciting new classes that are part of our 30 credit and 10 course program that we have here: Global Disruption and the Emergence of FinTech, the Evolution of Technology for Financial Services, and Launching FinTech Ventures. So if you're interested in applying to this program, make sure to apply by August 16th, or you can take this as part of professional development. And if you have any additional questions, please feel free to reach out to us at 781-736-8787 or at gps@brandeis.edu, and you will see our contact information on the final slide. While I am moving there and while we do have a minute left, I see that we had one other question from Nikki, which was, do you see FinTech continuing to evolve dramatically in 2016, and if so, how?
I think that is a very good question, and probably lead into that first course that you just saw on the last slide. I think probably the answers to that would you might get from that course. But yes, it's certainly evolving dramatically in 2016. There's a lot of turnover among fintech companies. Some are dying, some are being born every day. There's some estimate of there being about 12,000 fintech companies since 2008 that have started. So lots of different changes that are going on. It depends really what area you're thinking about. I know that in banking, it's a huge topic for us. We're spending lots of money on it. But certainly, I think we'd need another hour or so for me to get you much better answer than that.
Much, Tim. Um, so if you do have any additional questions, as you can see, our contact information is here on our final page. You can send them to us at brandeis.edu/GPS. I'd also like to invite you to connect with us through social media and subscribe to our blog to stay up to date on special events like today's webinar, some job posting spotlights, and networking opportunities. So I want to thank Tim Bosco again for presenting today. It was an excellent presentation, and I want to thank everyone for attending our webinar this afternoon. Everybody have a good day.
Take care. Bye-bye.